It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And I'll be a monkey's uncle. It is the man himself who's back in the office, Mr. Michael Becker. Michael, how are you?
Doing good. Just a little glad to be back in the office. I was on the road for the better part of 2 months now, so it's good to see my computer screens for a while.
That's great. As Michael has always said, this is not a business that you can stay behind your desk. You have to go out there and meet people, whether it's the brokers, the bankers, or the investors. You have got to leave your desk and get out to shake hands and kiss babies, as I would say, and meet your investors. So you have been going to do a couple of road shows. And so tell me a little bit about when you're meeting maybe a new capital source, maybe a new equity partner that doesn't know you. How do you break open that conversation right now, Michael?
Yeah, we've tried to get a warm intro, Paul. So a lot of this is talking to a lot of the brokers, saying, hey, who are you talking to that's looking to break into the market that might need some help, some local boots on the ground that can maybe be an introduction. We've been going to several conferences. We, just various forms of warm introductions are your best way. Some other ways is, we work backwards and see who's been doing some deals with some of our competitors and maybe trying to see if they still have some appetite and reaching out that way. So usually comes through some form of warm introduction, Paul. Then you just go either virtually or, in person or sometimes both. Both is probably better. Have a initial call virtually and then have an in-person meeting and kind of follow it up. And you're just telling your story. This is what we've done. This is what we're looking at. This is who we are. And this is what we see the opportunity in the marketplace today. And trying to find groups that have kind of similar alignment, similar thinking of where the world is right now. And that's really what we've been focused on the better part of the last 2 months, 3 months, really all year, Paul.
You've definitely been on the road and shaking hands and making new introductions. And whether it is somebody like Michael who's done 10, 12,000 acquisition of units, or it's you that you're on your first one, you have got to get out there and shake hands, especially in this marketplace, and meet new investors. Maybe somebody that has never talked or realized that they could be an investor in a hard asset like a multifamily property. So get out there and meet people. Michael, let's talk a little bit more about some of the things that SPI does. And I really like this one, the par for a purpose. Tell me a little bit more about par for a purpose before I ask and get into the interview. What's going on with the par for a purpose?
Yeah, so we're trying to our little way of giving back, and much like the old Capital. What is the this year's pickleball that you guys are doing?
Pickleball event. Don't forget about that. That is on April the 25th. Is a great event where we're sponsoring 26 different teams to play pickleball with us, and so come see us at that period of time.
Yeah, so kind of piggybacking on that, I've been supporting a local charity here in Dallas called Vogel Alcove, which is a charity that helps homeless kids in the greater Dallas area, and it's been a good mission and been a good charity for many years. And I recently got on their board last year, so I'm on the board of directors of Vogel, and we've been supporting them through our annual investor party for the last couple of years, and it just wasn't as effective as I wanted it to be. So kind of looking at guys like what you and James have been doing with your various charity things, we decided to do Par for a Purpose, which is at Top Golf. So it's going to be on May 15th, and we're going to email that out here to a bunch of people in our database. So it's going to be like a tournament at Top Golf. So anyone that's interested in that, you can just email us at support@spiadvisory.com, support@spiadvisory.com. We can send you some information about it. It's going to be the evening of May 15th. And unlike Paul's 3-on-3 basketball tournament of many years, hopefully there's no broken collarbones or wrist or torn ACLs or anything like that. This should be an injury-free event, hopefully.
Hopefully that is the case. So, Michael, we're sitting in the middle to the end of March right now in 2024. And I'm just looking for a sense of where you're seeing the market at right now. As you know, Michael is an operator of large multifamily class A, B, and some C properties in the Dallas Fort Worth area, Austin and San Antonio, probably the largest landlord in an old town just south of Boston called Kyle. And so trying to get just a tap of the pulse about what you're seeing out there.
Yeah, I think a couple thoughts. I mean, as we were ending 2024 or 2023, excuse me, was a friggin' roller coaster. So interest rates start a little high. They went low in March through first part of May when Silicon Valley Bank and SVB kind of blew up, and then we had a steady march from kind of latter part of May all the way until October when the 5 and 10 year Treasury both hit 5% there in kind of middle late October, and then kind of rates came back down and fell below 4%. And we were fortunate enough to rate lock a deal that we're working on refinancing right before the end of the year that closed last month. And really the better part of this year, rates have been kind of climbing back up from there. So we're kind of in that 430 range as we record this on both the 5 and 10 year Treasury, which is up from about 380 in December. So we've kind of had a little quiet 50 basis point high move up. But kind of entering the year, Paul, it seemed like the calendar flipped to 24. The interest was much higher. I think everyone's kind of got a little bit more optimistic. There was 6 to 7 interest rate cuts priced in the market starting in December. That half of those have been priced out, and the Fed meeting as we record this is in a few hours for March, and so we'll see what happens here in a couple hours. But I don't want to make a prediction and look stupid here in short order. But the trend's been kind of up, and we'll see if that reverses and the rates come back. But what is kind of in there is I think we're starting to see the market wanting to do more deals. There's a lot more people that have just been on the sidelines that haven't done anything for 12-18 months that are really, realizing that, hey, to be an organization that's a real estate company, we got to do transactions and we got to get going. And I think people are starting to feel confident in the fact that, there's probably not any more interest rate hikes. It's going to be a cut. So the extent and the timing of the cut is really kind of what is on the table. And then the other thing that people are going to kind of pay attention to, which is what I've been talking about for many, many months now, is, really it's been next to impossible to capitalize the deal for the last 12 months for our new construction ever since Silicon Valley Bank and First Public failed in March of 23. The banks have been, real restrictive and equity's been real tough. So, when Texas to build a garden deal, it's about 24 months from breaking ground to kind of getting it leased up. And on a wrap deal, a structured parking deal is about maybe closer to 30 months. But, here we are 12 months from a major event that shut off a lot of the construction lending. So, you just fast forward to, 12 months from today, we're in March of 2025, then, all the supply that has kind of been in the pipeline has been delivered, and is either leased up or finishing their lease up. So somewhere in 12 to 18 months from now, all the supply is in the rearview mirror. And we're going to be looking at, a oversupply market to undersupply market and basically the entire Sunbelt or, probably the entire country, to be honest with you, Paul. So, I think equity's seeing that and equity's trying to get ahead of that, at least talking about getting ahead of that. I think whenever we do see the first rate cut, that's when like everyone's going to rush in. That's kind of what it feels like. So we've been trying to position ourselves ahead of that. So we bought 5 deals last year. We're trying to buy some more now. So that's one thing. So that's kind of more on the top of the grade, kind of a little bit lower down the spectrum because of your A minus stuff, your 15, 20-year-old products, 9-foot ceilings, 2000s and newer. That's kind of the meat of the bell curve, talking to a bunch of equity partners. So, right now there's some money for core and core plus, which are kind of your class A deals. There's some money for 80s value add, but the meat of the bell curve is they want your 2000s newer 9-foot ceiling, 10, 50-year-old product. They could do kind of a first gen value add, light value add to it, but it's got better physical construction components to it. It doesn't have 8-foot ceilings, doesn't have cast iron sewers or chillers or aluminum wiring or all the stuff like the 70s, 60 vintage deals tend to have. So that's really the meat of the bell curve. And so we actually have a deal out right now. We just went to market with it. And, it's a '09 vintage deal, big units and good suburban location in Dallas Fort Worth. And they had a coming soon blast and didn't even have it on the market and had 20 tours scheduled in a week, Paul, on it. And the deal just went live. And I'm sure by the time we're said and done, we're going to be somewhere between 40 to 50 tours and 20 plus offers. It'll probably be 3 to 4 at the top of the pack and probably 16 that are at the bottom, maybe 10% off each other. And we'll kind of see where it shakes out. I guess time will tell. but it feels like we're getting a little bit of a scarcity premium right now for what's in vogue and what's in demand. And what we're probably gonna try to put a win on the board. This is a deal we bought before COVID and have a pretty good gain still baked in. It's not as good as it would have been, obviously, if we would have sold in 2021, but it's ancient history at this point, and we're trying to find ways to deliver capital back, and this is a good way to do that. So, that's kind of what we're seeing right now. And that's one final thing. I think you stole my stick on your last podcast I heard about kind of the '70s deal. Not saying it's no bid, but there's very little money for your '70s and '60s vintage deals, especially in bad locations, or if it has a bad physical characteristic like chiller or aluminum wiring. That stuff where the buyers are willing to pay is so far off of where the sellers can or are willing to sell that it's just frozen right now. So the meat of the bell curve is that 2000s and newer A minus value add. That's what the market really, really wants right now, and those are getting the most attention from all my conversations, Paul.
So you guys are not, you're selling an asset, but you're not selling a distress asset. And all these buyers that, whether they're new to multifamily or they want to buy all these distress assets. So what is your hearing? We talk about chatter. What are you hearing about some of these groups, and maybe even from the lenders, about what they're talking about with some of these distressed assets out there?
I'll give you my thoughts and throw it back to you. But I mean, I would have for sure thought that we would have saw some stuff started the second half of last year, 23, but it's like crickets. Right? I mean, these are just stuck in purgatory with the lender where, I know of several groups that are with a large lender that I have several put positions against. So my stock portfolio don't seem to be working out for me. That are monetary default, and the lender hasn't foreclosed on them, and so they're just, what I think is happening is they're letting them stay in if they feel like they're, somewhat competent. If they're not, they're kind of sweeping all the cash and taking up with their responsibility, but not foreclosing on it. But what's happening in the background is they're put default interest on them at 15-18% or whatever it is. And they're just kind of waiting, extend and pretend, and make sure the asset's in reasonable shape. And then when the market gets a little better, they're going to say, okay, we're going to go sell it, and any sort of equity above the principal balance of the debt is going to be wiped out with default interest that's been accruing for 12 or 24 months or whatever it is.
And again, what is default interest? A lot of people are not like bankers like you or I, but what is default interest? Because it's written in a big font on your loan documents, but people sometimes don't read that or understand what default.
So you have a stated interest rate, whether it's fixed or floating. If it's fixed, it's 5-6%. If it's floating, it's SOFR plus 300 or SOFR plus 400. So 3 to 4% above SOFR, which could be 8 or 9% today. And then when you get a default, they can then charge you a punitive interest rate in and above that. So it goes from maybe 5 or 6% if it's fixed up to 15 or 18% or 8% above the stated loan rate until the default is cured. And then there's attorney fees and other sort of fees that can tack upon it. So it could get extremely punitive and expensive. So a lot of these guys that are, kind of thinking that it'll just wait it out, but they're getting monetary default with a little bit more of a predatory lender, which a lot of the debt funds out there are kind of been a little bit more predatory by nature. You're going to default interest them, and when the market rebounds, they're going to find all the equity they have is going to get swept by this default interest, and the lender's going to take it. So that's what I think is happening in the background. But until then, lenders just kind of hanging on. They don't want to flood the market like they did 15 years ago with a bunch of distressed deals all at once. So we're just kind of stuck in purgatory where these deals are dead. They're like zombie deals, but the bodies haven't fallen yet. So that's what's kind of happening. So, those deals aren't on the market. Then even if some of these deals do hit the market with brokers represents the seller, but then the lender's like, you owe me $3 billion above what you think you owe me. And they're the ones really in charge. So some of these deals aren't even going to clear. So weird toxic soup that we're kind of looking at in the workforce housing deals that had bridge debt on them, so it's a subset of the market. It's not the whole market, but it's a subset. And like I said, we're selling a deal that's not distressed, that's got, high occupancy and good quality deal. And it's getting attacked because there's nothing else out to look at in the marketplace right now.
Yeah, it's a strong deal that you guys are selling. It's not in distress, high occupancy, a low loan balance, great equity into the deal. So you're not selling a deal that needs to be brought to the market. But some people who bought properties in the class of 2000, say 21 and 2022 that did non-recourse bridge loans and leveraged it up as high as possible. Some of them made payments maybe up until November, December this year. And then one group that we know stopped making payments because they thought they would probably try to force the lender back to the table to try to modify either the rate or the term or something that they were trying to pull different handles to make it more affordable for them. And the lender said, well, how much equity is into this deal left? And they said, well, there's some equity left. All right, we're not doing anything. We want the property back. And so they didn't so much foreclose upon the property. They just put it in default interest. And when all that equity at, like Michael was saying, at 18% on say a $20 million loan or a $15 million loan or a $35 million loan, that adds up pretty damn quickly. And all of that equity that was in there is gone. And so then the lenders out there, they become the broker on the deal, and they're looking for people to buy the property. So the brokers are trying to play brokers themselves like they've always been, but some of the servicers that actually own these properties, because they've taken them over from the sponsorship groups that weren't able to perform, they're going out there looking for people to buy these properties. And a lot of them don't want to, let's say it's a $20 million loan and you can only get up to maybe $17 million in the sales price. Well, they want you to buy it at $20 million, whatever that loan amount is that they currently own the property with. And then what they'll do is they're looking for a new buyer to take over at the $20 million. They're not going to charge off a $2 or $3 million from the $20 million and sell it to you at $17 million. They're going to find some ways to have you buy it at the higher price, just maybe restructure the debt, maybe also change the loan down, the terms of the loan, maybe get it, artificially lower that interest rate for a period of time since you can try to push up rents. So instead of bringing in 25 or 30% down, maybe you only have to bring in $1 million or $2 million to buy an interest rate cap or put interest reserves so you can make these payments on this property or buy an interest rate, something to keep this deal going. But these servicers right now, I see, they don't want to see foreclosures. They just want to change to a more strong jockey on a horse that they already let out the barn. Are you starting to get calls, Michael, from some of the servicers and asking you to kind of take over some of these maybe broken deals?
We haven't had a whole lot of that, but I know that's going out in the marketplace, Paul. We've had a couple conversations like that on the margins. So that's it. But I mean, a lot of the stuff they're throwing out just doesn't make any damn economic sense. So they're going to have to, they want to stay and get the majority of the upside, but then have you buy it at above market pricing because that's where their debt's at. So they got to get pretty damn creative for a lot of these clear. So I think you haven't seen a lot of it clear unless you're aware of some deals where they swapped out. I mean, here and there you hear about deals where they kind of, like you say, swap out the jockey. So the sponsor's out, new sponsor's in, and then the sponsor got a little participation of the upside without putting much money in it. But if they want the sponsor to put a lot of money in it and, pay above market basis and this and that, those deals they don't make any economic sense. So they're not really clearing.
What else are you seeing out there before we end the conversation here, Michael?
Like I said, I'm seeing equity get real, opportunely speaking, like they want to transact because they've been not transacting for a while. So I think, the bigger players, they don't want to buy the distressed stuff because they don't think it's cheap enough yet. And I generally concur and for the kind of some of those comments we just talked about. So they're, like I said, looking for your A minus. A little bit of those deals will buy some of the 80 stuff. The deals that are on the market that are getting attention are, getting pretty attractive cap rates. The values are off because your, insurance and taxes are up and maybe rents are down. And so the values are off the peak, but the cap rate's still holding pretty strong for the most part on your class A minus. And even honestly, even the 80s deals are trading a little tighter cap rate than I thought they would as well. I think it's really when you get into those 70s deals, when the floor kind of starts dropping out on cap rate and they really kind of gap out. And I've mentioned for years and years, it didn't make any damn sense to pay the same or similar cap rates for something built, brand new to something built in the 70s. And that's kind of where we were a few years ago. And those cap rates are widening out and have widened out and are continuing to widen out in real time, where the top of the grade, the better quality stuff, the cap rates are much more stickier and they're getting blown out on the bottom of the grade. So that's kind of what's causing a lot of this problem, on top of taxes. And insurance went up 20% on a Class A deal and went up 50% on a workforce housing deal. So just kind of getting hit left and right, and delinquencies higher on the workforce housing deals, and some of those pressures are just, which is a perfect storm for some of those workforce housing deals. But getting optimistic, and there's areas of green shoots, and we're seeing wins here and there. And trees don't grow to the sky, and you don't stay the valley forever either. We're better part of 18, 24 months into this crap. Really probably. So I realized it about April of 22, and May of 22, let's call it, when I was like, oh crap, this is gonna get a little messy. And so we're approaching 2 years of this crap. And I bet you we wake up in 12 to 18 months from now, it's a whole new ball game, and the supply is gonna flip, and there'll be the new administration or the same administration, and rates will be cut, and hopefully inflation will come a little bit more under control on a lot of our OPEX, and taxes will come in at some point, some form or fashion, and insurance won't keep going up 25, 30% a year. At some point, I hope that won't keep continuing. So, I'm starting to get optimistic. I think now is the time to lean in, and and we are continuing to lean in and trying to get some deals done.
So talking about getting hit with operating expenses, whether it's property taxes or insurance, a little bit like a fight, and you were out in California and you had Mike Tyson walk right by you.
Yeah.
And the following day it was announced that he was going to fight a 57-year-old guy, was going to fight a 27-year-old guy.
Yeah.
What'd you think about Mike Tyson when he walked right by you?
I was damned to say, he was sitting in my hotel in the lobby waiting for an Uber, and he walked right by us. And he's one of the most recognizable people in the world. Is no doubt who it was. He's got the face tattoo and short, jacked 50. He was a very fit 57-year-old guy you wouldn't want to mess with, that's for sure. But yeah, it was a crazy little celebrity sighting I saw the other day. So it was interesting to kind of see him. But
was he dragging his tiger with him too?
He didn't have his tiger, but yeah, no, it was anyways, but again, I think kind of the summation, I think, it's a tale of two cities in a lot of ways. You got some, higher quality deals that have been owned for a little while, that were purchased pre-COVID, or maybe like in early 2020 before the rents really started running in 2021 and went up, 20% in 2021 or wherever they did. So if you had that before, I think you're doing pretty good. You have a fixed rate mortgage with some term on it, you're doing good. You have a floating rate mortgage with some term on it, you're not doing as well, but you probably could survive as long as you kind of cover the cash in the meantime. It's these deals with maturities that are the problems. It's these 4 caps on 70s deals bought at the peak. Those are really the problem with floating rate bridge debt. So, these are all going to clear. I think we're going to get through it. I don't think this is 08 and 09. That was a complete mess, and we're starting to see the beginning of green shoots and equity start coming in. And I'm pretty confident for the better quality stuff that we kind of hit our bottom in Q4 of 2023, and I think we're kind of on the rebound up. And I think we probably have bottomed out on the workforce housing, and just had to be any transactions to crystallize that in the marketplace. So I'm a little worried, if you have a workforce housing deal, you need to sell it. I wouldn't wait around, because I think the better part of, there'll be a 12-month stretch where there'll be lenders selling deals, not owners selling deals, and it's going to kind of drag the pricing down. So I think if you need to sell, you should sell.
If people wanted to get more information concerning SPI and what you do, what's the best way of getting a hold of you?
Yeah, I think the best way is just simply our website, which is www.spiadvisory.com. That's SPI like spy advisory.com. There's a form you fill out, get in our database, get our newsletter, hear more information about future opportunities. I think we're gonna continue to lean in, try to buy deals, and hopefully, in 2, 3, 4 years from now, we're gonna look like the smartest guys in the room, that we had the courage to take action and get some deals done when a lot of other people couldn't or chose not to.
Well, let's not make it so long from last time to this time of having our Ask Mike Monday discussions. I know you've been busy out shaking hands and kissing babies, so Good for you and the team over at SPI. Again, Michael Becker, thanks for joining us. I'm Paul Peebles. Have a great day.